Bitcoiners, welcome back. We got another episode of Fed Watch. This week, we're bringing back the legend, Dylan Leclair. He has been working extremely hard at Bitcoin Magazine Pro, and they just dropped their May newsletter, their May monthly report. So great content set up. There's a lot to dive into. The Bitcoin market has been crazy. Welcome back to the show, Dylan.
Thanks, CK. Happy to chat with you and Ansel.
So we noticed that your 100K hat is gone. Sounds like you might be getting a little bearish. Excited to get into all the market outlook with you.
Did I wear that last time? Yeah, I guess I got to whip that out next time. Let's bring it back.
Hey, always be bullish. Ansel, what are you excited for?
Well, I just wanted to pick Dylan's brain about this new report. Tons of good charts in there. I mean, he covers not just Bitcoin all the important parts of Bitcoin, on-chain metrics, fundamentals, but also some macro stuff, which, we cover in depth here, like the CPI. We'll get into that towards the end. But first, Dylan, welcome back to the show. What is your biggest, overall market analysis of the sentiment of this market? Are we in a bear market or what?
Yeah, I would definitely say we're in a bear market. I don't think I need to say that down, 55, 60%. Just kind of classic bear market where I think news does nothing. I think just today I saw someone tweet about how PayPal, announced Bitcoin withdrawals, and it's like a fairly typical headline. But in a bull market, price pumps on something like that, right? We saw a huge capitulation of spot volume and derivative volume post Luna crash. And I think now it's just anyone that's kind of the speculators and the visitors are gone, and it's just kind of the hardened bets in the space, and we're we're due for some consolidation, and that's fine. It's nothing that Bitcoin hasn't done previously, and the last time it did so was around an order of magnitude lower. So nothing but a thing in Bitcoin world.
So do you think, you said they're classic Bitcoin bear market? Do you think we're going to go down 80%? Where are we in this consolidation?
Yeah, I think it's interesting because although Bitcoin did go to 64K and then drew down post China minor ban and went up to 69,000, it didn't really get too much of the blow off top, extreme parabola relative to previous cycles. So certainly anything's possible, and I like to tell people whenever they buy Bitcoin that at any point the price can go 50% lower than where it's trading today at any time. In a cycle or in the Bitcoin market. I think an 85% drawdown would be quite extreme, and I think there's a lot of support both from like a technical perspective and a volume perspective, as well as just kind of like a historical cost basis analysis, like what we refer to as on-chain analytics in the mid 20s, so like 25, 24,000. That's the average user cost basis. Certainly we've dropped below that in previous bear markets, and anything's possible. But prices kind of chopping around at 30,000 and looks like there's quite a bit of support under us.
Dylan, we've been talking about like a 29K kind of line where, it seems as though Bitcoin's holding. We've also talked about how the longer we stay in consolidation here, the more likely we are to test that next level down. What's kind of your take on where, this kind of line of support that we've been kind of ranging around?
Yeah, so the good news is the derivatives complex that historically, especially in kind of previous cycles, whether it was 2018-19 bear market where BitMEX was dominant to the March 2020 crash, the Bitcoin kind of, or I guess broadly crypto derivatives complex looks a lot better. So in terms of just the massive flash crashes, it would take quite a bit of spot inventory to get there. The derivative market liquidations that we've seen, say in May of 2021, when Bitcoin went from 40,000 to 30,000 in a couple hours, that doesn't seem like it's in the cards just based on the collateral type. So majority stablecoin margin for collateral, not Bitcoin, which is good for Bitcoin derivatives. And just by looking at funding rates, you can see relative positioning, and it's not very risk on. There's that speculative kind of activity that Bitcoin's going to the moon, 100K, leverage long, your longs. That sentiment is just not there. We can see that in the data. Never mind the sentiment. So positioning from a derivative standpoint looks really, really strong. And if we go to the last chart, it's chart 8 on the slide deck. That's just Sam and I included that. That's the spot volume. So that's showing Coinbase, which is obviously the dominant American exchange. And then the perpetual futures volume aggregated across a bunch of different derivative contracts. And so we can see those like various volume spikes. And so, historically, volume spikes of that nature, Bitcoin just trading hands in that size, signals somewhat of a market top or a bottom, just some kind of significant change in the market structure when you see that huge volume spike. And so certainly Bitcoin could go lower, but from a kind of a crypto native perspective, that certainly seems like somewhat of a kind of a capitulation event where a lot of kind of market participants just indiscriminately just dumped their holdings.
Very interesting. Yeah, there's another slide here. Number 2 is the liquidation events. And so this exactly what I was thinking, that it almost looks like there hasn't been a big bottom liquidation event, but then your spot volume here that you're showing on the other slide is showing this. So would you say there's still room to have more liquidations in the market? Because we always seem to have that, the big wick down at the bottom of or to set the bottom in these bear markets. Or my kind of preferred way of looking at this is, we're kind of bottoming slowly and we're building up on a base. So, or do you think there's more liquidations coming?
Yeah, I think, it just goes to show you the difference in market structure. So if we're looking at the, spring, summer 2021, where 70% of the Bitcoin market, the Bitcoin derivatives market, was actually using Bitcoin or crypto as collateral. So there's like a really convex nature to that during drawdowns, where your collateral is going down, and your P&L is going down, and also these traders are paying 40 to 50% annualized rates to leverage long Bitcoin. So imagine taking out a 50% loan from your bank to buy Bitcoin at 60K. Obviously, that's not going to end well, and that's essentially what traders were doing, obviously with a variable financing rate, but it was extremely elevated for a long period of time. And that all got wiped out. So now, those rates to long Bitcoin are right around neutral to long or short. And it's just traders paying between each other, and the collateral type has changed. So I think a derivative liquidation is obviously possible, and we're going to see Bitcoin chop around, but to the size and magnitude we've seen in, previous kind of huge capitulation events, say, of Bitcoin's past, it just doesn't seem to be in the cards as of now. And obviously that can change with the traders positioning, but it seems like most everybody's, completely de-risked in the derivatives landscape.
Awesome. So is that a sign of decoupling in general between altcoins and Bitcoin? And then how would you expect that to move forward in the future? Do you expect like, say, stable coins get regulated? Is that going to help altcoins, or vice versa? What do you think is this decoupling between altcoins and Bitcoin?
Yeah, well, I mean, I think certainly in bull markets, altcoins, while obviously they're very different from Bitcoin and their value proposition, they're often just kind of riding off the liquidity tide and serve as beta Bitcoin, regardless of if they have any value whatsoever. They almost have some sort of embedded monetary premium due to the influx of newcomers in this space, and they, Bitcoin pumps 5% and random altcoins go up 10%, 15%. And certainly, if you look at the alt BTC charts, whether it's Ethereum or name your favorite altcoin from the past 2 cycles, the chart in Bitcoin terms has topped, and it looks actually really, really ugly. And so regardless of, I think, whether Bitcoin goes up or down, I expect in a lot of these, large altcoins load up coin market cap and, pick your choice. I think in Bitcoin terms, there's a steady bleed happening, especially kind of post Luna debacle, while all of these altcoins aren't structured in the similar way that Luna is, where it's going to hyperinflate in supply if the peg breaks of its stablecoin. A lot of people, I think the confidence was shaken in what the actual long-term value prop of these layer ones of these projects are. And that's why, they're just, continuously bleeding out in Bitcoin terms, which is, what matters in the crypto complex.
I mean, all of this stuff is just oscillating around Bitcoin. There's one of my favorite charts was actually posted by my boy, Nick Ward. But it was kind of like the Bitcoin price action and then all the other altcoin price action, and it really was very clear where the signal was and where the noise is. Dylan, I want to jump into a lot more of these charts, but I also want to talk a little bit about Bitcoin Magazine Pro and what you guys put together every single month with this monthly report that we're going to dive into. Can you just talk a little bit about that stuff and maybe even tell people where they can find the monthly report if they want to learn more?
Yeah. Sam Rule and I, leading off Bitcoin Magazine Pro, essentially just want to objectively dive into the Bitcoin ecosystem, whether that's just the pure price action of Bitcoin. We cover Bitcoin mining, we cover the macroeconomic landscape as Bitcoin is increasingly becoming intertwined with the macro landscape. We cover derivatives. We kind of just combine it all to try to present a transparent view of what's happening. We use a kind of a data focused and data oriented approach and a lot of visuals, as well as just kind of narrating what our thoughts are with what's happening. And so you can find that at bitcoinmagazinepro.com. That links right to our Substack. Give it a shot if you haven't seen it. We have a free tier where you can kind of test out what we do. And we put out stuff 4 to 5 times a week, as well as a monthly report post every month.
So Dylan, what's in this monthly report? And I guess get us started on some of these charts that we should dive into.
Yeah, so essentially we kind of did a synopsis, a brief one of the kind of collapse of Luna and then the overall kind of crypto market, just the liquidations that followed, as well as with Bitcoin. We also have kind of a variety of cyclical indicators that we use with the on-chain data that kind of quantifies hodler activity and overlays it with price to give just kind of a zoomed out view of where Bitcoin's trading. We have certain kind of metric valuations just to objectively quantify whether Bitcoin's relatively cheap or expensive. And we also cover some of the derivative stuff to show you what institutional traders are doing and whether they're risk on, risk off. And so for the most part, Bitcoin's been somewhat in a bear market over the course of 2022, and Bitcoin has become an increasingly more attractive buy relative to what we follow. But we also cover some of the macro stuff where not so much this month, but last month, or I think 2 months back, we went in depth on the Russia-Ukraine conflict and some of the maybe second and third order effects that result or that will result from that. So we like to cover it all. We try to, at least. We don't get everything, that's for sure, but we do our best.
Yeah, no, it's an absolutely beautiful report as well. It's just diving into it. Crypto implosion, where you break down what happened in Luna, and then you just get in, to all of the nitty gritty with what's happening in the Bitcoin market. So, really a great resource for someone who doesn't want to spend time on Twitter and who doesn't want to spend all their time staying up to date. The monthly report and your weekly and daily emails, really fantastic. So really recommend it. Let's dive right in. I mean, Ansel, is there a chart that you are really interested in talking about, or what should we do next?
Well, I wanted to ask Dylan, is that the first chart that you showed there with the spot volume? Is that your highest signal chart, you think, or what on this report, this most recent report, what was the best chart that you got?
Yeah, I would say that's one of the bigger ones. I think just in terms of kind of a framework for evaluating whether it's a bottom or not, everyone wants to know. This is one of the kind of classic signs. I think also just in terms of our macro view, and this is not so much Bitcoin specific, but it relates to our underlying Bitcoin thesis, is the 10-year treasury yield and the CPI. We've been covering kind of the bubble in the bond market, the everything bubble, for quite a while, and Bitcoin's obviously subject to that. But I think that's one of our favorites, number 7, as well as number 5, which is just kind of Bitcoin relative to its cost basis. That's it's a really, really great way of viewing the monetization of Bitcoin. So I would say I gave you 3 answers there, but those are probably my top 3.
All right, well, let's dive into number 7. Let's pull that one up, and can you talk us through this chart here?
Yeah, so here's the 10-year treasury. The U.S. Treasury is basically the risk-free rate or benchmark that the global economic system, financial system is built upon. And CPI, the consumer price index, this is showing the year-over-year inflation as measured by the CPI bucket. And obviously there's, this has been subject to change, but this, for better or worse, is what Wall Street and the financial system uses as that inflation rate. So what we've been covering in particular is how, there's a few $100 trillion of assets that are being valued post 2020 with a negative real yield. And while, the bond traders would tell that, you can't use CPI, which is, the trailing inflation rate, and you have to use forward inflation expectations for real yields. Well, that's fair, but I think there's also some signal or the reality that some of those forward inflation expectations are wrong. So what's happening, and the big problem that everyone has, even if they don't know it's a problem, is that when you have CPI inflation at 8%, or maybe even real inflation at 10, 15%, while your benchmark bond yield, your risk-free rate is giving you a 3% yield, there's a problem. And the problem is the cost of capital has been manipulated so long, and there's, something is broken. And so, our kind of thesis is, over the long term, even though Bitcoin on the shorter to medium term is subject to the ebbs and flows of the liquidity tide, over the long term, Bitcoin is an emergent monetary asset with a production cost that's programmed to increase forever. And so, that's why we we focus on bonds and everything else, is we believe that the investor community has yet to kind of figure this out or wrap their head around it, and we kind of see this as the pool of capital that is going to need Bitcoin the most going forward.
Absolutely.
Yeah, I wanted to jump in. I was going to say, a lot of times when I pitch Bitcoin, Bitcoin is money that works, and everything that we're using now just doesn't work, plain and simple. But it's interesting to think about. It's like, Bitcoin is like a store of value that works, and it competes against bonds, it competes against real estate, it competes against fine art, gold, all the above. So really interesting to see how it stacks up specifically against bonds, which is, right now you would say that's the conservative safe haven asset when you think about how most people split up their portfolio.
Yeah, and fixed income investors, not only because of the real yield, but especially when the long bond was trading, below 100 basis points, fixed income investors, bond investors have been killed because of the duration aspect of bonds, right? Because yields have risen, and that that principal value of those bonds goes down the further out they are on the curve. So say you're a 30-year bond investor, yields go from 100 basis points to 300 basis points. The value of those bonds, mark to market, draw down a ton. And so that's kind of what we've seen. That's why we've also seen like growth stock equities draw down in tandem as well, because of that duration aspect. And so while Bitcoin, interestingly enough, despite having no cash flow, despite having no coupon or no yield, has been treated as kind of this risk on long duration asset, we kind of think that's a short-sighted view of what's happening, and that it is a no duration asset, and actually is an optimal asset to hold in the face of unprecedented inflation and monetary debasement. But that's reversing, so we'll see.
Yeah, you bring up so many awesome points. The value of the bonds on your balance sheet, if you're banks, right, and you're holding a bunch of treasuries and they drop in value, now you're underwater. And so you can see how these typical credit cycles work. And what you need is a sound money underneath that to put a bottom in underneath the market, so the credit doesn't just collapse to nothing. So anyway, let's go on to chart number or slide number 6. This is CPI again. Let's stick on this topic for one more chart. And this is, I like how you have year over year and month over month. So can you walk us through this? And then also, do you think CPI is peaking? We hear a lot of that out there in the financial press.
Yeah, I mean, I will say, I'll preface it with saying I'm not an oil trader. I despite following along as best as I can, I'm not a geopolitical strategist. So I think it's, it might be just ill-advised for me to try to time the consumer price index rate of change, or whether it's peaking or not. But yeah, I think, when you are looking what the Fed's doing and what they're embarking upon, it's that inflation is becoming a political liability. It's, for the longest time, it nestled itself in asset markets, in the bond market, in equities and real estate. And now it's being felt by consumers who are looking at the gas pumps and seeing $5 a gallon, $6 a gallon, going to the grocery store and coming out with a bill that kind of blows their mind. And so in that sense, Powell and the Fed is trying to tamp it down, and whether their tools, their monetary policy tools, are the best way to do that is probably another discussion. But what they're trying to embark upon is reversing the wealth effect by stamping down asset prices and tightening monetary policy to reduce consumer demand and spending. And so I think looking at the CPI year over year, or the month over month, and seeing whether that's accelerating or decelerating can help you do that. But ultimately, there's so many variables at play. It might just be not worth your time to try to time it perfectly.
Yeah, I like the month over month. That's my new favorite measurement, because the year over year can hide so much from early on in that 12-month period. So month over month of the headline CPI in April was 0.3, which annualizes only 3.6%. And if we have another low month like that this month, maybe another 0.3% print for the month over month change, then I think people are going to start looking like maybe CPI has peaked, and that could change the whole conversation with the Fed and tightening. So real quick before we jump onto the Bitcoin charts, what's your thought process on Fed's hiking of interest rates, and will they pause, or monetary policy question here?
Yeah, I think really, while the Fed is jawboning, and while Powell is, kind of going up there and talking down or talking up the market, I think really the Treasury market has done most of the Fed's work for them. And obviously the Treasury market is swayed by what the Fed says, but the Fed's fundraise is at 75 bips, I believe, and the 10-year Treasury is at 3%. So even if the Fed hikes to 150 bips tomorrow, the Treasury market's already did that for them months ago. And so I really think that I hold the fundamental belief that with the debt levels that we have really around the world, the whole euro dollar system, but also just the federal debt to GDP and the deficits that probably will need to be run to win the next election, and the political promises that come with the fiat currency system, I think that there is no way that real yields can sustain to be positive. Kind of going back to that chart we showed with the 10-year Treasury and CPI, to erode these debt levels, going back to 2011, the IMF was writing about it. How do we erode the debt burden? It's financial repression, negative real yields. And so even if the Fed funds is at 300 bips, 350 bips, I believe that inflation will have to run over that for a sustained period of time. And because of that, fixed income in real terms, I believe has already experienced if you want to look at, say, the long bond, I think the long bond in real purchasing power terms has already topped, and that's kind of I think that will continue even if in nominal terms you're experiencing gains.
Dylan, I put out a tweet, I think it was yesterday or 2 days ago, saying that the Fed is killing the golden goose that they didn't actually know they had. I was kind of referring to this idea of like the fact that the Fed's only monetary policy tool is expectation management and effectively jawboning, as we have referred to it here. And by tightening so much and not realizing that the market is actually, pulling all the strings, that they're almost killing their own illusion, right? That there's this illusion that the Fed controls things, and by tightening, it's like they're going to expose that they're not actually in control. What do you think about that idea?
Yeah, that's a really interesting topic, and a lot of smart people that I follow and respect have said similar things, in the sense that they're just kind of like the wizard behind the curtain. And if you look at the Treasury market and you look at the Fed funds rate, oftentimes during hiking cycles or during loosening cycles, the Treasury goes below, like Treasury yields, are really leading the Fed funds rate and kind of bossing around what they'll do. This is what happened leading up to 2020. Repo market kind of imploded. Fed funds the Treasury market yields were already going down before they started cutting again. And so I think honestly, there's a possibility that if they do get what they want and kind of destroy demand and the wealth effect reverses so hard that we start to see a deflationary collapse, yields will start to drop dramatically. And this is just one of a few different scenarios that I could see happening. which will, it'll stop hiking for the Fed. And really, it's just kind of, it was always just an illusion. And it was, monetary policy was never really at the whims of, a few guys in ties. And it was always just about really where the market was going due to debt and demographics.
Ansel, do you want to jump in, or should we go to the next chart?
Yeah, let's go to the next chart.
All right, let's go to chart number 3. So if you listen to me for a long time, my favorite indicator is the 200-day moving average, and the current price divided by that, commonly referred to as the Mayer multiple. You have a beautiful chart here, kind of teasing out where we are based on that. And it's interesting to think that, hey, we're overcooled, but theoretically Bitcoin price could go lower and the Mayer multiple will actually scale with that. And it just depends on how long it takes to go lower, since that 200-day moving average does get kind of, it moves along. What are your thoughts on the 200-day moving average and the Mayer multiple, Dylan?
Yeah, I mean, it's one of the simplest, but in that sense, it's one of the best. Bitcoin is a trending asset. There's a ton of momentum in the market. And so if you're just buying relative to its 200-day moving average, and not advising you sell Bitcoin, but when it's, deep in the red, overheated, oftentimes, it's showing that, hey, there's room for some downside, there's room for some consolidation, and vice versa, right? Like Bitcoin is trading at, 75% of its 200-day moving average. And throughout its history, that's like the 10th percentile of its low readings. And so the back tests there are obviously fantastic. Past performance is not indicative of future results, but if you are a value investor and you don't think this thing is going to die and go away forever, it looks like a pretty good time to buy. So in terms of our cyclical metrics, the Mayer multiple is one of the most simple, but it's one of our favorites.
How do you compare this oversold type of reading here on the Mayer multiple, and how do you combine that with maybe other things like the liquidations and with the Fed, the funding rates, because those other two aren't quite as I would say oversold as the Mayer multiple, right? So how do you kind of compare and contrast these?
Yeah, so the Mayer multiple, and obviously just by using a 200-day moving average, it's more of kind of a medium to longer term outlook, where derivatives are oftentimes shorter term, even though structurally they can remain kind of not irrational, but the way I think about derivatives is with spot Bitcoin, you can short the dollar, you can sell a dollar to buy Bitcoin and never cover your short, essentially, right? You can lock your Bitcoin in cold storage and never have to sell it back. But with derivatives, whether you go long with leverage, or even if it's just 1x, or you go short, you always have to get out of the trade. You always have to close your position. And so there are times when Bitcoin is very kind of susceptible to is over leveraged to the long side. Derivatives are leading the spot price, and there's a ton of kind of leverage built into the system. And there's times where derivatives are trading below the spot price, and that could be because of liquidations. That could be because of just trading and sentiment and kind of derivative traders, leverage traders trying to drive down the price of Bitcoin, which is like what we saw in the summer of 2021. And right now it's about neutral. So for that reason, over the shorter to medium term, I'm not really expecting like a huge liquidation event from a derivative standpoint. That doesn't mean spot price can't go lower because of legacy market conditions, or the VIX spikes to 60. Right? These are all things that the macro, the derivative landscape, the spot market, they're all somewhat intertwined. But for the most part, the Mayer multiple is something that I'm considering when I'm buying spot Bitcoin and locking it away. Not when I'm, well, not personally, but if I was trading derivatives, I wouldn't, the Mayer multiple is not something that I would really consider all that much.
Cool. So let's combine those last two topics with the Fed, monetary policy, and these, kind of like market structure here. Is what's your anticipation for what Bitcoin does if the Fed continues hiking until they break something, or if the Fed actually pauses or pivots, which I don't think they'll pivot, but let's say they pause in July or September. What do you think the effect on Bitcoin will be?
Yeah, so obviously the equity market correlation has been strong throughout 2022. I think in terms of the spot capitulation, we've seen a lot of the HODL metrics that we look at, something as simple as like Bitcoin held over 1 year, right? That's not very advanced at all, but that's at an all-time high in absolute terms and percentage terms. And so we see exchange balances declining once again, not quite there, but almost at 3 to 4 year lows again, post kind of Luna event. So drawing down once more. There's, really anybody that's kind of sold because of the Fed, or sold because of QT, or sold because of, any of these kind of legacy market correlations, has likely already done so. Not saying that that price can't go lower, but these worries have been voiced for quite some time and aren't catching the market by surprise anymore. And so I'm not suggesting a decoupling happens tomorrow, but the events that have played out so far, the intense correlation that we have seen, and I think the kind of the neutral de-risk derivative market is kind of, this is what eventually leads to somewhat of a decoupling, right? And so obviously confidence was shaken a little bit in the crypto industry, if you want to call it that. Bitcoin's obviously different than crypto, as we think and believe, but eventually, this is where the seeds are sown for a decoupling event to happen. So certainly, correlation traders, everything else can drive day-to-day movements, but in terms of a significant decoupling from the NASDAQ, these are the conditions that we look for, and this is what kind of again sows the seeds for that event.
I want to get your opinion then on a chart that I think I tweeted this out just the other day, maybe last week, where I looked at the pivot from January 2019, where Powell paused and then reversed. It had to do with rates, but I lost it. Well, if you look back at that time, like you said, rates do precede down before the Fed pivots. And we're kind of seeing that a little bit too. You mentioned the 10-year and the 30-year, but if you look even a little bit shorter to the 2-year, the 2-year sitting about 2.5%, 2.6%. And if they will get there in 2 hikes, right? They'll be at 2.5% in 2 more 50 basis point hikes, right? So I don't know if the 2-year does start coming down and the Fed funds is going aggressively higher. I mean, that differential that spread could close very quickly. Can you maybe speak about that a little bit?
Yeah, I mean, I certainly follow the treasury market pretty closely. Not a bond trading expert, although I'd like to claim to be, but I am not. I think it comes down to the deceleration or acceleration of CPI, like we were talking about earlier. No one really knows what to expect, although there are inflation expectations you can watch. The price of oil, right? Like we're kind of at the whims of OPEC, whatever Putin really says. He's obviously got Europe in a really tough situation. And so there's so many factors at play that, I think can affect the bond market. But in terms of a structural sense, I like to look at this like, multi-decade, 40-year long secular trend of interest rates. And, there's a great 10-year chart. Some people call it the chart of truth. And we're already kind of above that breaking point where, yields really can't materially go much higher without kind of breaking things. Even if, again, real yields are deeply negative in nominal terms, it's not something that this historically over-indebted economy can handle for too long. And so that eventually leads to these deflationary impulses where everybody rushes back to the treasury market. And so, in terms of the short end of the curve, the long end of the curve, not sure how high it can go. I certainly think it could go higher, and I wouldn't be in bonds for anything more than, especially the long bond, for anything more than a trade at this moment. I still think they bleed value over the long term, but certainly, closer to a top than they were with, 6 months ago, or a bottom, I'm sorry.
All right, let's go to this other chart that was one of my favorites here from the recent report, the Bitcoin price weighted by reserve risk. Can you walk us through this one? Because it's also looking like it's at relatively historic oversold conditions, right?
Yeah. So reserve risk is one of our favorite indicators, and we've explained it in depth in one of our pieces. I think it's going back in the fall, but essentially reserve risk, it packs a ton of data and info into one chart. So it essentially weighs the incentive to sell price by what's called HODL bank, but HODL bank really is kind of the cumulative opportunity cost foregone by hodlers. Okay, so let me say that again slower. Essentially, it takes a whole bunch of metrics in, weights coin days, it weights basically how long you've held Bitcoin, all Bitcoin throughout history, and it comes up with a cumulative opportunity cost. How convicted are the hodlers? So it basically weights hodler conviction, whether that's strong or weak, and with price. And so times where reserve risk is very, very high are times when hodler conviction is very low. When hodlers are spending, they're dumping their coins. A lot of coins are changing hands. At the same time, that price is very high. Not a great time to buy Bitcoin, even though some will say it's always a great time. At bottoms, reserve risk is showing that price is very low. At the same time, that hodler conviction is very high or increasing. And so, explaining the technicalities of this indicator over it is, we won't do it justice. There's a ton of data that goes into it, and we've actually backwards computed it to better understand it. But we really love it as one of the cyclical indicators because it just packs so much data and info into one simple metric. And by all means, it's very, very oversold. And historically, based on what we've seen, I think this will be looked at as a fantastic time to buy.
Yeah, it looks like it hasn't been this low since the COVID sell-off back in March of 2020. And I don't know. I think it looks like it might be able to continue to stay low at that point. But if you look up and compare it to the price can just creep northward and start the next bull market, even while it stays low in the green there for a while.
Yeah, certainly. And the interesting thing about this indicator is that price can move up, and the indicator can stay flat or even go down as that kind of hodler conviction, as calculated by this metric, increases. So if kind of cumulative hodling is increasing and strengthening, this indicator can stay low for quite a while and signaling that it's still a value you buy. So there's no one metric that anybody should kind of gauge all their decisions off of or base all their decisions off of. But certainly something like this can weigh into your decision whether it's a great time to buy or not. And by all means, it is.
This is a really cool metric. I really like very, very simple metric that pack a lot of information. That's why I like the Mayer multiple. Kind of tells you what the price has been over the last 200 days and then how the current price compares to it. I like how this compares what are the long-term UTXOs doing? What are the old UTXOs doing? And you've seen old UTXOs moving at cyclical tops. Like that is a very, very common thing. And, that chart beautifully illustrates that. So really cool. And while it kind of seems fancy, it's actually a pretty simple metric as well. So I love simple metrics that pack a lot of information. So that's an awesome, awesome metric.
Yeah, I think if we want to go to number 5 on the slide deck, this is probably my favorite one, my favorite on-chain metric to describe, as well as, just to look at it. I think if you strip away like all the noise, you'll often hear that Bitcoin is far too volatile to work as a currency or to work as a monetary asset. But one of the coolest things is that because of the transparency of this network, we can see when every single Bitcoin has ever moved, when it was mined, and we can also overlay that with the price to come up with what we call realized value or realized price. And so I think maybe easier to understand is realized market cap, which is just the price of every Bitcoin it was last moved aggregated. So realized price would just be that divided by circulating supply, and we can kind of come up with an average price of all Bitcoin that's ever moved. And so historically, that's much, much less volatile and draws down much, much less than Bitcoin does. And when Bitcoin's price actually goes below this level, so currently it was like $24,000. That's been the bottom or close to the bottom of a bear market. That's kind of signaled somewhat of a capitulation event. So does that happen again? Is it guaranteed to happen again? It's absolutely not guaranteed, but just using this kind of like simple average cost basis framework, we can see when the network average, when everybody is underwater, and so on average. And so I think it's a really cool thing. The market value to realized value ratio kind of really shows, like I like to call them like monetization bubbles. You can kind of see like the 4-year cycle encapsulated in this simple ratio of the price to the realized price. And so, again, no metric is the do all end all, but just in terms of evaluating Bitcoin's rise, evaluating Bitcoin's monetization, this is one of the favorite and the most transparent.
Yeah, I think this is fascinating. And I noticed something on this chart as well as on many of the other ones, like the Mayer multiple and stuff. The peaks seem to be getting lower, and so do the troughs seem to be getting higher. So this is going to lead into my cycle thing. You said a monetization bubbles. What's your take now? I think we talked about this multiple times in the past on your past appearances, but has your idea about cycles, has that solidified or changed recently?
I think a little bit. We're obviously more at the whims of macroeconomic, the macroeconomic liquidity tides than ever. But I think, and I really don't think that halving is the leading driver of these cycles anymore. But in terms of the velocity of these cycles, or just how fast Bitcoin appreciates, obviously at $1 trillion or a 500 billion dollar asset, it's much harder. It's much harder to appreciate by an order of magnitude or two. And so, it certainly makes sense that the peaks are a little bit lower in some of these ratios and like cyclical market measures. I think the NVRVZ score. So if you standardize this data, it kind of eliminates some of that, and it looks like a better chart. But that's a different topic. But yeah, I think that it makes sense, and it's kind of a natural progression that even though Bitcoin's still volatile, it's less volatile to the upside and the downside during these kind of phases. And I think that's actually pretty healthy. If Bitcoin doesn't draw down by 85% every few years, in terms of overall adoption, that's probably a good thing.
My only take on this is it might be getting less volatile, but as soon as it seems like it's not going to be volatile, I think that's when the volatility really, really goes up, because at some point, a lot of value needs to be convinced to transfer over to Bitcoin. And we have no idea what that's going to look like, but I know for a fact it's going to be volatile.
Agreed.
I was just going to say, I think we covered all the charts here. Other stories I have, or do you have any other comments on your newsletter or the charts? And then I wanted to maybe pick your brain about the upcoming Loomis proposal in the Senate.
Nope. Nothing on the report. Fire away.
Okay, so what have you had a chance to look at the proposal? I know these guys here on the stream, they just talked to Caitlin Long for about an hour, and it was awesome. I mean, she is the expert in this field. But what are your thoughts? How will a kind of a regulation or a regulatory framework around Bitcoin, how will that affect macro? Maybe are there any implications that you would see or that kind of pop out to you?
Yeah, I honestly, to be completely honest, I haven't looked at it in depth other than kind of the headlines this morning. So I think I'd be doing it, an injustice to comment on it after Caitlin Long just, probably dished out some wisdom over the hour prior to my appearance. But is there anything from your end that you found particularly notable?
Well, yeah, I mean, they have things in there about making Bitcoin obviously under the CFTC as a commodity instead of making all crypto assets or digital assets, they call it in the proposal. All digital assets would be under the CFTC unless otherwise determined by the SEC. So I think that this could put like a Bitcoin spot ETF maybe a little bit more likely. And I think it's good for Bitcoin, but I disliked that they lumped in these ancillary assets, they called them, in with Bitcoin and made them kind of seem default commodities unless proven otherwise. So that was kind of my takeaway. But of course, this is a year or two away from becoming law, but it is the first step in a framework. And I think it's really important because I do think the US is going to lead the way in a regulatory friendly way. And so I think this is the first step along that.
Does Ethereum pass the Howey test?
Technically no, but according to this, because there was a write-up on Bitcoin Magazine this morning, and they said that Bitcoin and Ethereum were guaranteed to be commodities, and I thought that was kind of crazy. But yeah,
it is insane to me that they keep including Ethereum. And again, I'm not a lawyer, but it seems so clear that there was a event that violated US law, just cut and dry, and what has happened since. My take so far is that altcoins are DDoS on the reputation and the capabilities of these enforcement agencies. And for them, we can look at it like, oh, wow, how could they let Ethereum through? But for me, what I see is there's cracks, and there's going to be more cracks. and I, just how much fraud happened during the ICO stage and what is being unveiled now with this most recent run up. They just can't enforce on it quickly enough, right? I do think it's interesting. Hey, default commodities, unless otherwise stated, I feel like that gives an advantage towards people spinning up altcoins, but it also shows nuance in that, hey, if something is a kind of digital commodity, it shouldn't be treated like a security, but a lot of these things are securities and will be regulated by the appropriate institution. I like that it doesn't create a brand new like regulatory body that puts them all in the basket. Like, I think that what this is doing, it shows understanding in a much deeper way, I think.
Is Luna 2.0 a commodity or what?
You're asking the good question, so I don't know. I don't know.
And
that's
Ethereum,
that's for the SEC to determine, right?
Ethereum pre-merge or post-merge, which one is the commodity?
Yeah.
I have a question or an idea to present to all of you, because finally someone sides with me. Thank you, Ansel. There's a caveat to this that I really don't like, which says that if you are deemed a security, you can, in essence, like send forms or applications twice a year to the SEC saying that you are in compliance to remove the label of security off of your offering. So I personally think this is a really messy, poorly designed bill. I think Lummis caved too much. This is not my show though, and I'm going to stop talking, but I wanted to throw that little caveat in there that there is literally an exit hatch. Even if you're deemed a security, it's like, oh wait, but don't worry guys, we got you covered.
Yeah, I think the default position is this ancillary asset. And so it's not really a commodity, but it'll be treated like a commodity according to the SEC. And then the SEC can come back and kind of claw back those worst offenders, if you will. I don't like that either. And that's kind of like creating a new category just for all these altcoins. And like Christian said, he was glad that there isn't a new agency, but now it's almost like a new category between a commodity and a security, when all of these things should be securities, except for Bitcoin should be the only real commodity out there.
Yeah, I mean, I'm not one to wish imprisonment or law enforcement to clamp down on anyone in particular. I'm not. I would say I'm more of an anarchist than not. But at the same time, the SEC is completely over their head. They're going after someone that made $20K working at OpenSea, flipping some JPEGs, while a $60 billion Ponzi scheme just imploded, listed by U.S. exchanges, right? So they're way over their head. And I agree with CK that there's just way too much that they can, that they can't address. There's just too much.
Again, like the end game to this is like the way we regulate things is going to completely change. The capability to regulate is going to completely change. And this like idea that you can regulate these things with the SEC or with securities and put them on regulated exchanges, like that is going to get obliterated by just the sheer number of bullshit, right? They just can't. It's like too easy to crush them that they just can't stack up against it. They can't man these agencies and operate efficiently enough to actually prevent it from happening. And what you're seeing is, the longer that these agencies are shown to be incompetent, that's where the politics come in. And then they're forced to bend the knee even further with this other stuff. So what we're seeing right now, my interpretation is we're seeing the takedown of these regulatory agencies slowly, right? Their power is being exposed, just like the Fed is being exposed. They just can't deal with it. And the more that they try to squirm and enforce, the less credibility you have. Never once has the SEC gotten so many complaints about a product, right, as they are about the Bitcoin ETF. Like that's another DDoS that's happened, right? So, they just can't win. Their structure it won't scale into the future. And we're seeing that on multiple angles.
Well, they can win if they just say Bitcoin only. Bitcoin's the only asset. Everything else is unregistered security, and we're going to enforce that. I mean, that's the line they'll eventually have to draw, right? Because yeah, you're right. If they don't draw a line, they're just going to be DDoSed to not irrelevance, which I guess could happen. But
that's the path. I'm just saying that's the path.
But I think they'll choose.
The Fed fix their woes, maybe. The Fed embrace Bitcoin. I don't think the incentives lead that way.
Well, if it's between being irrelevant and choosing Bitcoin only, I think they'll choose Bitcoin only. But anyway, this was a great show. Dylan, thanks for coming on, man. Should we wrap this, CK?
Yeah, no, Dylan, we have to educate this audience. What do they need to know about Bitcoin Magazine Pro? What are you doing? I know you have some open recs out too. So maybe talk about some of the roles that you're looking for.
Yeah, Bitcoin Magazine Pro, we cover all things regarding the Bitcoin market, like we talked about: macro, on-chain, derivatives, Bitcoin mining, treasury yields, legacy market volatility, everything in between. You can find the publication at bitcoinmagazinepro.com. We publish on Substack 4 to 5 times a week. We are looking, in terms of roles, we are looking for a product manager, as well as an analyst / manager of a new paid tier where we're actively managing capital. So if you have interest in either of those, you can go to Bitcoiner Jobs, where they're listed, I believe.
Yep. So we got some jobs, some really cool jobs, and you would get to work with Dylan and Sam, who appear on this show frequently. Maybe you could appear on this show as well into the future. So join the Bitcoin Magazine team, subscribe to Bitcoin Magazine Pro. You know, you got a little taste of all the awesome information that these guys jam into their content. And I'll like to plug them in again. Tomorrow, Dylan and Sam are jumping on to continue talking about the Bitcoin markets. That will be available on YouTube as well as on Spaces. So a lot of good stuff coming out here. And Dylan, where can people Q, what do you need to say?
I want to highlight the most recent BM Pro issue where the dynamic duo of Dylan and Sam just ripped apart Bitcoin v crypto. Highly recommend. I'm going to be forcing them to go into those charts that they shared with us. So you're not going to want to miss that.
That's going to be up. Dylan, where can people follow you on Twitter?
At Dylan Leclair _. I'm there. Just find me. I, just chilling, interacting. You can DM me if you, have any comments, questions, concerns.
Watch out for the fakes. Dylan will never ask for your sats or ask how your trading is going. Ansel,
that is true.
Where can people find you?
Oh, at Bitcoin and Markets. I do a weekly newsletter every week on Friday, and it covers close to the same thing over there that Dylan is covering, except mine, I think, is a little bit more long form than his is a little bit more chart heavy and data heavy. But bitcoinandmarkets.com, and you can follow me on Twitter at Ansel Lindner.
All right. Give Ansel a follow. Give me a follow at CK_snarks. This is really the only content I do is on this show with these guys, but it's always a good time. And I'm going to send it back to you, Q.
Also catch CK Snark in like an hour and a half in Twitter Spaces, talking to Nathaniel Harmon and a really awesome group about sustainable Bitcoin mining. So CK's a liar. Make sure you also follow him on Twitter.
Yes, CK_snarks. And I forgot about that, but I actually have to prep for it. So that's going to be going live on Twitter. And we also record it. So Bitcoin Spaces Live. You can find all of our spaces on podcast. That's enough shilling from me. Guys, I'm handing it back to the team.
Thank you to the FedWatch team for joining us. We're going to keep this smooth, simple. Use promo code FOMO. Get 10% off of everything at the Bitcoin Magazine store, including the Moon Mag, or this lovely Bitcoin 22 hat. Limited supplies left, and we do also have a new magazine coming very, very soon. I believe it's being sent shortly to print. We're just waiting for one last article to come in. CK, finish your homework already. But in all seriousness, be sure to grab a subscription if you're not already subscribed to the print mag. I can't keep my job if you guys don't buy tickets to Bitcoin 2023. So buy tickets to Bitcoin 2023, Bitcoin Day, Charlotte, right? Saturday, Bitcoin Day, Charlotte. If you're in the area, make sure you go down, catch our producer, Chris, who's going to be hosting a panel out there, as well as a couple other Bitcoin Magazine team members who will be speaking. Be sure to check it out if you're in the area. Stay humble. Stack sats.
Talk to you tomorrow.